So good afternoon once again. Our topic for this afternoon until this evening is about monetary and fiscal policy. So here are the objectives of our class for today. So after completing this module, the students should be able to first define monetary and fiscal policy, and then identify the objectives of both monetary and fiscal policy, to determine the types of monetary and even fiscal policy, to differentiate the two policies, and at least be aware of some regulations mandated by the Bangko Sentral ng Pilipinas. So the Central Bank of the Philippines. So first, we need to define what is monetary policy. So according to an internet website, Investopedia, it is a set of tools that a nation's central bank has available to promote sustainable economic growth by controlling the overall supply of money that is available to the nation's banks, its consumers, and its businesses. So it is an approach, a tool who facilitates the central bank of a nation or a country that is intended to promote sustainable economic growth. How does the central bank do it? By controlling the supply of money that circulates within the economy of the nation, the spending behavior of the consumer and the businesses. So we will explain it further as we get into the examples of monetary policy. So the three major monetary policy objectives are: first, it is used to manage inflation; second, to reduce unemployment; and then to promote moderate long-term interest rates. So please take note of these three. Why a monetary policy is being implemented by a nation's central bank. So to manage inflation so that unemployment rate will be lessened or reduced, and then to promote long-term interest rates, that is borrowing or lending rates. So there are two types of monetary policy, that is contractionary and expansionary. So what does contractionary monetary policy means? It is intended to reduce the rate of monetary expansion to fight inflation. So the key words here are reduction of the rate of how much the money circulates, and second is the purpose, which is to fight inflation. So the tools for a contractionary monetary policy are: first, when we say tools for a contractionary monetary policy, it is the approaches, the ways on how to implement this kind of monetary policy. So the tools for a contractionary monetary policy are: first, the central bank increased the short-term interest rates, increasing the interest rates. Second, it raises the reserve requirements. And then finally, by expanding open market operations, that is by selling securities. So how does it specifically works? Each of these tools for contractionary monetary policy. So first, let's discuss increasing the short-term interest rates. The central bank may choose to increase the cost of short-term loans by increasing its interest rates. The commercial banks, in effect, will raise the interest they charge to their clients. So the central bank, which is that is why it is called central bank. It is the common bank, the bank of all the banks in a nation. So it lends money to the commercial banks in a specific country. So it increases the cost of short-term loans. It increases the interest rate it lends to the commercial banks. So what is the effect of increasing that interest to the commercial banks in the nation? Those commercial banks, as we all know, there are different types of commercial banks, the most popular banks. What is the effect of the central bank policy of making the interest rate higher? The central bank to commercial bank, and then the commercial bank will charge their clients higher interest rates. So in effect, in reality, when a commercial bank increases its interest rate, less people will borrow. Of course, comparing to a higher or lower interest rate, so a higher interest rate will generally make the public less prone to borrowing money from the bank because they will pay higher cost. The interest is higher. Second, raising the reserve requirements. So we all know that there is a specific requirement of money to the circulation. So when there is a rise in the required reserve amount, it will lessen the supply of money in the economy. When we say reserve in the central bank, we have a specific amount to be reserved, and even in the banks. So when we rise, I'm not saying this is the reserve amount. For instance, a reserve amount of 10,000, 10 billion, for example, when we make it 11 billion, what will happen? The supply of money in the economy will lessen because instead of circulating within the country, it becomes or it forms part of the reserve amount. So when the central bank raises its reserve requirements, the tendency is that the supply of money within the economy will lessen because it forms part of that particular reserve amount. Third, it expands open market operations. The central bank can lessen the money in the economy by selling government securities to investors. So instead of spending more in the general economy, what does the central bank do? It sells government securities to the investors. So when it sells securities, there will be a restriction of flow in the money within the nation. So what will be the effect if a central bank implements a contractionary monetary policy? First, the inflation reduces. Second, the economy or the economic growth slows down and unemployment increases. How? So how does a contractionary monetary policy reduces inflation? So policymakers want to reduce inflation and stabilize the prices in the economy. So like today, there is a news that a higher inflation rate was recorded. So to reduce inflation and to make the prices more stable, so policymakers implement a contractionary monetary policy. Because when inflation continues to soar high, what happened to the prices and in the commodities and services? It goes up, right? So for instance, the diesel, the gasoline, the petroleum products, it keeps on rising. The prices continuously go high. So to make the prices more stable, a contractionary monetary policy must be implemented. So it also slows down economic growth. How? Individuals and businesses halt expenditures and investments, and companies slow down their operation. So we have mentioned earlier that during a contractionary monetary policy, interest is high, interest rates are high, therefore, and prices are high because inflation is high. What is the tendency of the individuals and businesses? Instead of spending money, they freeze their expenditures and investments. So when expenditures and investments are halted and the companies slow down their operation, their production, the economy, the growth of the economy will slow down. Because people and businesses choose to not spend their money, just to keep their money for themselves. Who would buy prices? Who would buy products that are too high? Of course, except for the basic commodities like the foods and the petroleum products, especially for those who have vehicles. They need those products for running their vehicles. But for those products and services that are not a necessity, so this time is being used to halt or to freeze their spending, for their spending and investment. Since we have mentioned that economy slows down, production for a moment may be halted, may be stopped, or maybe in a lower level. What happens to the employment rate? Unemployment increases. The slowing down of economy means lesser hiring because there is less opportunity, less production, less spending. It means no hiring or lesser hiring, and thus it causes higher unemployment. So we see the economic activities have relationship. They are interrelated. So we are through with the contractionary monetary policy. So when we say contractionary monetary policy, from the word contract, reduction of the supply of money circulating within the economy. So now we speak of expansionary monetary policy. Expansion, expand. Instead of restricting, it aims to increase the rate of monetary expansion so that the growth of economy will rise, will be stimulated. So see, the two are equally different policies. One is to restrict circulation. The other one is to spend more, to expand more the supply of money within the economy. So what are the tools for expansionary monetary policy? First is the decrease of the short-term interest rate. Second, reduce the reserve requirements. Third, although it is the same with the first one, but rather than selling securities, now it is buying back securities. So how does the central bank decrease the short-term interest rate? So it makes the interest rates lower. Therefore, the commercial banks will also lower its charges to the customers or to the clients. What is the effect? More clients will be able to secure a loan from the bank because it implements a lower interest rate. Second, lower the reverse requirements. A decrease in the required reserve amount will increase the supply of money in the economy. Let's go back to the example a while ago. Let's say the reserve requirement is 10 trillion, for instance. Now, if we're going to reduce it, for instance, 9 trillion, what will happen to that 1 trillion? It will circulate within the economy. Therefore, it will increase the supply of money in the nation. More supply will be used by the people, can be used by the people, and might be used by the people. Expand open market operations. The central bank may opt to buy government-issued securities from investors to add cash in the economy. So the contractionary monetary policy is more of selling government securities. Now, the expansionary policy is more of buying back those government securities so that more cash will flow in the nation, in the economy. So what would be the effect of an expansionary monetary policy? It will give higher inflation, stimulation of economic growth, a decrease in unemployment, and currency devaluation. First, higher inflation. The additional money put in the economy increases inflation levels, which can be both advantageous and disadvantageous. So there are pros and cons in higher inflation rate. So, but an expansionary monetary policy will give us or will give the economy a higher inflation rate. Expansionary monetary policy also stimulates economic growth. When the cost of borrowing reduces, consumers are most likely to spend and business will invest more. We have already explained this one. So when there are more expenditures, more investments, the economy will continue to grow. Opportunities will come. And therefore, unemployment will decrease because more opportunities, more jobs, more productions, more investments are created. A growing economy entails more businesses hiring employees. And finally, currency devaluation. A higher money supply means lower value of local currency. Devaluation is beneficial to an economy's exporting ability. So here again, so when there are more supply of money within an economy, it means the local currency, uh, the value of a local currency becomes lower. So it is being devalued. But it is still beneficial to our exporting ability because of the conversion rate. So again, it has both advantages and disadvantages. So we're through with the monetary policy, the tools, and the types of monetary policy. We're now going to define what is fiscal policy. Again, according to Investopedia, a website in the internet that is specifically used or for explaining financial matters. Fiscal policy refers to the use of government spending and tax policies, including aggregate demands for goods and services, employment, inflation, and economic growth. So John Maynard Keynes is a British economist whose ideas largely influenced the development of fiscal policy. He believed that the governments could stabilize the economic cycle and regulate economic output. So please take note of John Maynard Keynes. So he was an economist, a British economist, whose contribution to this fiscal policy is largely attributed because he believed that the government, the officials, have the power and authority to stabilize the economic cycle and the outputs in the economy. So let's differentiate the monetary and fiscal policies. So the main difference between the two is that monetary policy is being implemented by the central bank, while the fiscal policy is headed or facilitated by the government. So please take note of this, of their difference. The one who implements or facilitates. So the keyword, one of the keywords here is aggregate demand here. So government spending and tax policies, including aggregate demands for goods and services, employment, inflation, and economic growth. So what is aggregate demand? In Keynesian economics, it is demand or spending is what drives the performance of an economy. It includes consumer spending, business investment spending, net government spending, and net exports. So the demand, the aggregate demand or the aggregate spending is what moves the economy as a whole. So how the consumer spends, how the business invests, how even the government spends, and how it exports affect the growth of the nation's economy. So just like monetary policy, it also has types. Fiscal policy can also be expansionary or contractionary as well. So what is expansionary fiscal policy? When people pay lower taxes, they have more money to spend, which fuels higher demand. This would mean lower unemployment and labor competition. Wages would also increase and would provide consumers more money to spend and invest. You see, the economy is a cycle. So at first, the scenario is a lower tax. When the tax is low or lower, what is the expectation? More money can be spent by the people, and when there is more money, it means higher demand. When there is higher demand, it would mean low unemployment rate and labor competition. So when there is a labor competition, strict and strong, wages would increase because businesses would see to it that they can hire employees. To hire employees, they will increase their wages and salaries. If there are more money as form of wages and salaries, people who are also consumers have more money to spend and invest. So instead of lowering taxes, the government may seek economic expansions through increases in spending. So instead of granting lower taxes, what will the government do? It will increase its spending. Expansionary fiscal policy is usually characterized by deficit spending when government expenditures exceed receipts from taxes and other sources. So meaning more than what the government earns, it spends more when it is implementing expansionary fiscal policy. In practice, deficit spending tends to result from a combination of tax cuts and higher spending. Where expansionary fiscal policy involves deficits, the other type, which is contractionary fiscal policy, is characterized by budget surpluses, meaning the government spends less than what they earn. So there will be a surplus in the budget because the government spends less and it earns more in the form of revenue taxes and other legal collections. You know, class, contractionary fiscal policy is rarely used because it is hugely unpopular in terms of politics. Because in politics, officials usually spends more than what the government can earn because of many reasons. One of those is that social services must be continued. And in our nation, in our country, this is more popular. Our government spends more than what it earns because contractionary fiscal policy is rarely even being used. So who handles the fiscal policy? Fiscal policy is enacted by the government. So again, I would like to reiterate to you that the difference between the monetary policy and the fiscal policy is the one who facilitates or implements. This time, fiscal policy is enacted by the government. How does fiscal policy affect people? It affects people in various ways depending on different situations and applications. So let's give a real world example of expansionary fiscal policy. So it happens during the American Recovery and Reinvestment Act of 2009. So you may just explore more of this by researching on the internet, but I am just stating that these are happening in the real world. So contractionary fiscal policy is a strategy where the government decreases spending and possibly increases taxes with the aim of reducing economic growth in order to balance their budget. It works by curbing inflation, reducing employment rates, and increasing interest rates. So see why contractionary fiscal policy is unpopular, not or rarely being used, because it increases taxes. And the government knows that when you increase tax, people will have clamors, will be disappointed, right? Because who would want a higher taxes to be paid? But in moments that it must be used, like when there should be a balancing or harmony within the budget of the government, it must be implemented. So how does it work? It curbs inflation, it reduces employment rates, and increase interest rates. So contractionary fiscal policy tools increase taxation and reduce government spending. So what are the real-world examples of contractionary fiscal policy? So Greece implemented it on 2008, while United Kingdom implemented it on 2010. So who handles the fiscal policy? We have already mentioned this. The government handles the fiscal policy. So let's just take a look and browse and be aware of some regulations as mandated by the Bangko Sentral ng Pilipinas. That is included in our module for study. So RA 3565, an act to require the disclosure of finance charges in connection with extensions of credit. RA 6426, an act instituting a foreign currency deposit system in the Philippines and for other purposes. Republic Act 3591, but amended as RA 7353. So an act establishing the Philippine Deposit Insurance Corporation, the PDIC, and an act providing for the creation, organization, and operation of rural banks and for other purposes. So take a look at this law. This is one of the most basic laws in relation to the central bank. The act establishing PDIC. So the minimum amount of insurance. So the minimum amount that a depositor can get in case a bank becomes bankrupt. You must be familiar with this as finance people, the PDIC. The minimum deposit or the minimum amount that a depositor will get in case the banks become bankrupt. So RA 7653 is the new Central Bank Act. Just study why is it called the new Central Bank Act. RA 7721, an act liberalizing the entry and scope of operations of foreign banks in the Philippines for other purposes. RA 7906, an act providing for the regulation of the organization and operation of thrift banks. So the other types of banks, thrift banks. RA 8366, as amended, PD or Presidential Decree number 129, the Investment Houses Law. And RA 8367, Revised Non-Stock Savings and Loan Association Act of 1997. RA 8556 is an amendment to RA 5980, otherwise known as the Financing Company Act. RA 8799 is the General Banking Law of 2000. Also, please remember this important law, which acts providing or an act providing for the regulation of the organization and operation of banks, quasi-banks, trust entities, and for other purposes. C, RA 9160. This is one of the well-heard laws, financial laws, the Anti-Money Laundering Act of 2000. So you must be mindful of this one, the Anti-Money Laundering Act of 2000. RA 9178, an act to promote the establishment of barangay microbusiness enterprises, providing incentives and benefits therefore and for other purposes. 9182, an act granting tax exemptions and fee privileges to special purpose vehicles which acquire or invest in non-performing assets, setting the regulatory framework therefore and for other purposes, and the IRR or the implementing rules and regulations of that particular law. So on 2003, the Anti-Money Laundering Act of 2000 was amended as RA 9194. So RA 9238 is amendments for the National Internal Revenue Code, the one we use in taxes. So there was an amended for that. RA 9294 is about exemptions. 9505 is about PERA, personal equity and retirement account. RA 10,000 is about agriculture and agrarian reform credit and financing system through banking institutions. RA 10167 is further amendments to the original Anti-Money Laundering Act. So see, at this particular time, 2012, the Anti-Money Laundering Act is further strengthened for the third time. RA 10168 is a defining the crime of financing of terrorism. So in this law, it is said that when you finance terrorism, it is a crime. 10574, allowing the infusion of foreign currency in the capital of rural banks. 10641 is to allow the full entry of foreign banks in the Philippines, which amends the Republic Act number 7721. So we see before this law, the foreign banks have no full permission to conduct a business. But here in this law, the foreign banks has been granted full entry. RA 11127 is the National Payment Systems Act. RA 11211 is the new Central Bank Act Amendment. And that's it. Thank you and God bless.